This video is geared towards high net worth individuals, but even if you're not that, you can still use some of these concepts to benefit your financial future. That's really the goal of this channel. It's one of the goals of this channel. It's to share some of the strategies that we use with our clients and then share it with you so that hopefully you can take advantage of these things as well. The really good news is that you don't need a massive skill or some edge to take advantage of a lot of these strategies. But what you do need is some proactive planning, some thinking ahead over the next few years. Again, it's not rocket science. I'm going to be talking about performance and investment alpha. And then I'm going to talk about what high net worth people focus on to really 4x any investment alpha that they might be able to eke out. And I'll explain what that means very quickly. I'm Dave Zoller and I own Streamline Financial with Tim and Luke and Sean, and we help a select number of clients. But we created this channel to hopefully share some of those principles and practices and some of the tactics of successful investors and hopefully share it with everyone. So I hope that you find this helpful. Now, here's what I mean when I said high net worth people can achieve 4x any investment alpha. Now, when we're talking about performance and talking about investment alpha, alpha really just refers to the excess return earned on an investment above the benchmark return. And there's these billion-dollar firms out there and hedge fund managers that really compete and really try to outperform each other by 0.1% or 0.2% per year. But the high net worth clients that we help, we can really just work smarter and not harder and get 4x what that 0.2% was, or 4x above that 0.2%. And I'll share what I mean. You know, some of these topics that we're going to be going over, you've heard about, and you might actually think it's kind of boring. The first one you definitely know about, and that is taxes or tax planning. Now, if you can do some of these things correctly, that's where this high savings is going to be when you compare it to investment performance. And really, it might just blow the investment performance out of the water. And here's what, just to recap really quickly, we've got investment alpha and then we have tax alpha. And as I bring some of these tax alpha concepts up, you might be doing some of these already, but probably not all of them. And some of them do take proactive planning and coordination between your financial team. And the financial team, I'm talking about CPA and your attorney team, and then your financial advisors, and then possibly insurance advisors. And hopefully your team is already advising you on these things, because a lot of the time it requires all of them to be coordinated and talking together. And I know a common thing that we hear from clients, sometimes the client feels like the middle person, you know, trying to communicate and coordinate all of these things, which is never a good idea, or rarely a good idea. What we would say, or what we prefer or try to do to help our clients is really, if this is you, and I'd say having a point of contact or a lead, or whoever that kind of, if you use football analogy, the quarterback of the team, even if these are not at the same place and they're different, separate companies, have one person that's able to coordinate and talk, and that's your go-to. That way, if you don't want to be the CFO or, you know, do 99% of the work, then you can focus on those really important things like family, faith, and friends, and fitness and fun, and whatever else that brings you that fulfillment and joy. So that's kind of how we see it when we're helping our clients. Let's dive into the first tax planning strategy. And these could be worth thousands, if not hundreds of thousands of dollars. And again, you might have heard these things and think, oh, I've heard this already, it's nothing new. But are you applying them to your finances? My guess is that you're applying some of them, not all of them. The first one is one that you know about, but you might not have that optimal strategy just yet. Really, it's one of the topics that is brought up a lot in our first call that we have with people. They know of it, but they're not applying it. It has to do with your pre-tax 401ks and your IRAs. For many people, these are great vehicles to defer tax and let grow tax deferred, but there's gonna be a time later on when the government forces you to take out of these and pay tax, even if you don't want or need the income. And eventually, they'll force your heirs to draw down on the accounts and possibly end the accounts in 10 years max after they're inherited. So the idea of Roth conversions comes up quite a bit. But Roth conversion can be quite costly if you're still working and earning a high income in your 50s or 60s, or even if you're in your 70s. The trick here is to find out what your tax rate is now, and then map out what the future tax rates could be as well. And you can look at a few what if scenarios. We never know exactly what tax rates will be after the sunset in 2025 or what it's going to be the next 10 years, but you can look at a few different scenarios. We sometimes know or do know that, like many things, taxes are cyclical. So mapping out these what if scenarios and projecting what it could look like in your 70s to see what that dollar amount is going to be and what you have to take out of the accounts and then compare it to now. Retirement-focused advisors, they're really good at this because they do it all the time and they can clearly lay out a few routes that you can go. But here's just a high-level example to think about. So pretend you're 55 and you've got a $3 million 401k. Now, by the time that you're forced to take out and take out withdrawals, that could be worth $11 million. And that was just using a simple 7% growth rate. So the comparison, again, high-level comparison is pay $1.2 million now in taxes, or you and your family pay $4.4 million later in taxes. Comparing the future to now and seeing what could be better for you and your family, that's a big, big thing. I mean, where else could you get a $3 million additional return on investment alpha when planning, right? That tax saving strategy can really mean a lot. Now, before we get to the next one, can I ask you a question really quick? Is this video helpful so far? If it is, click the like button so that I know, and then maybe other people can be helped as well. Now, the next big thing, again, you've heard about, but it's often overlooked, and it has to do with many clients or people having appreciated assets, and they've got unrealized gains in their portfolio, or they have a business, or they have real estate, or maybe all three of those things. And also, many clients are charitable. So down the road, if you have a business sale or a real estate sale, or possibly you need to do a reallocation of the portfolio, some clients can add one little thing to their strategy to really optimize that plan even more. And that's by using a low-cost donor-advised fund. So let's say that you're planning on moving your portfolio slightly more conservative, and you're selling a business or real estate, any of those things. And pretend that you're also charitable, and we'll just make up a number that you're given $10,000 a year. You can take two routes. You can either keep giving the way that you're giving each year and do 10K for the next 20 years. Or you can think about in that year, let's pretend this was the year of the business sale, and there's going to be a taxable event of say $2 million, you can think about pre-funding this charitable intent or pre-funding your giving for the next 20 years. And here's, there's kind of a double whammy when it comes to tax savings here. So this is your business over here. And if you can think about, what if 10% of your business was first gifted charitable intent into a donor-advised fund? And again, just using flat numbers here. So you just pre-funded, in this example, 20 years worth of giving in 1 year. So you can get the deduction in the high income tax year, and you can also lower the business sale dollar amount, or what the value of the firm is. So the taxable event is actually lower as well. So that's kind of the double benefit of this. So hopefully that's coming across good enough through this screen right now to get the idea. If this is interesting, let me know. Give me a reach out on our website, and we could talk through this even more. We actually offer a free charitable planning strategy session where there's no intent for working together, but it is really just about, if you're charitable, really maximizing this in these big years. So let me know if that's important. You can see that below. Now, the next thing that really makes quite an impact for high net worth clients' portfolios is what I would call phantom taxes. And here's what I mean. A few years ago at the tax firm, we had a client come in. They were not a streamlined financial client, not an investment client or retirement client, but just doing taxes. And we completed the return and we were reviewing it. They came in before we actually filed it and signed it. And this is years back. And they were shocked at how much tax that he had to pay. It was the husband that came in, and we showed him the reason and why this was, and it was additional income. They had to pay about $60K from capital gains in his portfolio. And he said, but I purposely told my advisor not to sell anything this year because of the high income year. And I said, he didn't sell anything. These are capital gains happening within a fund that wasn't sold, but within the fund, there were sales happening out of your control. and it's just a very tax efficient fund. So we started looking at how to create a tax efficient portfolio so that he could have more control over when to actually pay taxes. So we often say that you can really two things you can control sometimes in your portfolio. Maybe there's a few more, but two we definitely know about are taxes and cost. Now, the next topic is estate taxes. So you hear about Congress changing rules and the laws and the amount of, how much, what the estate value has to be before you have to start paying estate tax, and they may be lowering it in the future and all these things. I remember a few years back in 2010, I think, is when Congress couldn't agree, or they couldn't agree in 2009. So 2010, there was no estate tax, zero. And that was the year that George Steinbrenner, owner of the Yankees, passed away. So that was I guess, not a win, but at least when it comes to estate taxes, they had to pay zero estate tax, I believe. But in reality, if you don't want to pay estate tax, you most likely don't have to, even if you've got tens of millions of dollars. And I was learning this from a family office, another owner of a family office, and he was saying it's easy to not pay estate taxes, but it's not cheap to get it set up. But the cost benefit is pretty clear, and it can be done by setting up some certain trusts for your heirs and some charitable giving, and then sometimes some insurance. Really, the key here is integrating that tax management and integrating the estate side, and then also insurance, and making sure that it's a team, or at least they're communicating well. That's the big takeaway from this. That's how to avoid some of those mistakes that people make and avoid paying more than you have to in tax. That's really the important thing. And you don't have to be uber wealthy to achieve this either. If you want help thinking through these things, reach out to me and we could talk it over. Just go to streamlineplanning.com and then click on the Get Started button, and then I'll get back to you that way. So thanks for watching, and if you're subscribed, then I'll see you in the next video.